One of the things that I hadn't talked about yet is, which kind of is happening, but then there's also why it hasn't taken place yet, is the housing market, right, in 2024. Now, I talked about adjustable mortgages. My mortgage personally is at 3.75% for 30 years, right? I was lucky enough to refinance and lock it in. Could I buy a house today, even with my financial status? Absolutely not. In California, especially, because when the rates went from 0 to 5%, mortgages went from 3.75% to 7.5%. On jumbo loans, probably higher. So even this is with good credit, by the way, right? With a good credit score. And a lot of people have been expecting, right, housing market crash, right? Well, I'm going to kind of connect this with the affordability side of the issue. Um, it, when the rates go up to on mortgages from 3.5, 4 to 7.5, 8% on a 30-year fixed, which is the most popular, mortgage these days. Um, your payments on that mortgage is going to double automatically for the same price of the house. If you're buying $1 million house, which in California these days buys you a shack, right? Let's say you have the $200,000 to put down 20%. You take the mortgage out at 80%. That same mortgage at 3.75 or 4% versus 8% is a double. Are you making double the money that you were making last year to sustain that servicing of that debt? No, nobody's going to give you the loan, right? And so the demand for housing is not there. However, what else is happening is that there isn't too many houses going on the market from people like me. My house has doubled over the last 20 years. Okay. But now I'm thinking, okay, I can sell the house and take that equity. But if I have to go buy something else, I cannot downgrade yet. I have kids at home that are in college. Once we're empty nesters, maybe I'll downgrade, go to a townhome or something with the wife. But at the moment, I have to go in another house. If I go in another house, well, I'm going to sell my house at double the value that it was 20 years ago. But then now I have to go buy something that's double the value itself, plus the mortgage. I cannot sustain that kind of mortgage. I cannot make payments on that kind of mortgage. So that's why I don't think it has added to the pain. Meaning, a lot of people with 3-4% 30-year fixed mortgages are not selling. They're not sellers. Although they have massive equity gains, they've accumulated a lot of equity in their homes. They're not selling. So because of that, the market is kind of balancing itself out, right? But if you're a new buyer today, okay, if you're just starting life, if you're in your 30s, let's say you graduated college, you're married, you have no kids yet, but you're planning on, having a family with kids, you're out in the market for a house, right? The affordability index is absolutely in the tank. And home buyer conditions for U.S. consumers have declined. We talked about consumer sentiment going down, right? And home buyer conditions for U.S. consumers have declined to an all-time low in June 2024. Look at the chart on the right-hand side. Look at the big circle on the right-hand side. This chart goes back to 1990s, I think it's, let's see, 1980s, 1990s. Yeah, 1990 to 94. We are exactly where we were back then. Why is that? Well, because of inflation, housing prices have gone up, mortgages, interest rates have gone up. How does let's say you're 30 years old, you graduated college, you got a great job, you're married, your wife has a great job, two incomes. Let's say you save the money. How can, with this affordability situation, how can you get into a new house? So the demand on housing is not there, right? Because of affordability, not because of anything else, not because we're not building any more new homes. And the existing homeowners are not selling because wherever they go, they cannot afford the higher interest rates or higher mortgages that they're going to have to face. So that's why I think the housing market is just kind of holding its own, because there's not a flood of sellers in the market trying to grab that equity like myself, because I'm thinking, well, if I sell it, I go somewhere else, I can't afford the new house. So I'm going to stay put. Okay. But for younger people who are starting life, it's not there. The affordability is not there. That's with the assumption of them having a 20% down payment, right? So the index of buying conditions is now at 27 points below the previous all-time low recorded in the 1980s. Think about what we're doing. And this is all connected to the deficit problem that created the inflation, raised the rates. All this is connected, okay? And this was when 30-year mortgage rates were between 12 and 19%. These are true numbers. I remember those days in 1979 when Paul Volcker was trying to kill inflation and he raised the short-term rates to 20%. People, we had 20% interest rates in the US. 5 is not high, so don't complain about 5. 5 is actually lower than average. And in those days, right, the 30-year mortgage was between 12 and 19%, but then the housing prices were not that high, right? And now the mortgages are about 7.5%. Since 2020, the index of affordability index has dropped by a massive 80%. Think about it. Now, when we had zero interest rate policy, everybody was flipping homes, speculators were flipping homes, people were buying homes because mortgages were 3.5%, incomes were keeping pace, no problem. But then what happened? Not only the prices of homes went up because of inflation, okay? The interest rates went up now to kill the inflation that they created by printing money. So double whammy. You guys see what's happening here now? And is this going to create a housing crash? I don't think it is, just for the fact that people like me cannot sell and go anywhere. I'm not going to sell. I cannot sell and take my, I don't know, $700,000 equity that I've, accumulated over the last 20 years because I can't go anywhere. I can't afford the house that I need to get into the next one. So I'm staying put. That's why there's not enough sellers in the market. So it's kind of balancing things out. And meanwhile, the U.S. median home sale price reached a new record of 400,000. This is the U.S., all over the U.S. We're at $400,000. Okay, and housing, and so there something has to give. Okay, either that 393 U.S. median is very high, or right, that has to come down. The only way affordability is going to move from that chart that you guys see on the lower right-hand corner with the big oval around it is two things. One, interest rates go back down. But if interest rates go back down, inflation is going to reaccelerate, and that housing price at 393 is going to go to 420 next year, right? So, or what has to happen is there has to be a recession. Housing prices have to correct by 20, 30%. Then the Fed will cut the rates. Then the mortgages will be back down to 4 or 5%. Then the affordability index will kind of balance itself out. Otherwise, good luck. If you're starting life, trying to create a family and put a family together and get married, unfortunately for the newer generation, affordability is not there.